So over on my Facebook page, a gentleman named Brett asked me, is it really worth converting my traditional 401k to Roth? And as we were kind of chatting back and forth inside of the thread, he made the comment that his friend who worked for the same firm, has the same retirement, and is now retired, told him, don't believe what they tell you about your tax rate going down in retirement. Well, you know what? I absolutely believe that is true. Now, a lot of people always said, well, if my lifestyle drops, my tax rate will drop. I don't want my lifestyle to drop. But you know what? You could still have your lifestyle drop and your tax rate go up. Why? Think about all the money the government has put out for COVID relief. The government's broke. We have a huge national debt. Somebody's got to pay for it. Eventually, those tax rates are going to go up. So, in theory, you could have a higher tax rate in retirement, even if you have the same income that you had when you were working. Yeah, not necessarily a good thing. Now, back to, should we convert from traditional to Roth? In most cases, I say go for it. The key is knowing how to mitigate the taxes. Now, before we even get into all of this, let me tell you, there are plenty of online calculators that will tell you how much income tax this will generate to convert from traditional to Roth. And I normally do not advocate converting the whole thing at one time. There's all kinds of facts and circumstances that surround this. Let me give you an example. If you were going to convert from traditional to Roth, but you were going to keep this money in the stock market, okay, so you're not managing it, it's in mutual funds, it's in the market, whatever, it's only pulling in about 12% per year. Well, you're not going to really be able to stomach the huge tax hit of converting everything at one time. You're going to need to do this over time. Whereas, let's say you're going to self-direct the funds and you're going to do the 3 flips that you're allowed to do with real estate inside of the 401k. So if you're self-directing, all of a sudden the rate of return has gone from here to here. I had a client that literally rolled $500,000. He converted $500,000 from traditional to Roth in 1 year. He paid the taxes. He was a real estate professional. He went in there and made loans and did his 3 flips. And you know what? In less than 6 months, he had made back the principal that he lost to taxes. So was it a good idea to convert it? You better believe it was. So my first question for everyone is, are you being smart? My second question is, what's your rate of return? Third question, how old are you? If you are getting into your 70s and 80s, then the tax hit, you may not be able to make it up in your lifetime, and you would be better off just leaving the money right where it is. But someone my age, mid-50s or 60s or even very early 70s, for that matter, somebody older that can take care of the tax hit in other ways, hey, why not go ahead and do it? Okay? So I'm going to break it down, and I'm going to show you some ways to mitigate the income taxes that you would have to pay on a conversion. All right? Let's go to the whiteboard. All right, guys. So let's start by kind of explaining the difference between traditional 401k and Roth 401k, or traditional IRA and Roth IRA, and what happens when you move one to the other. Okay? On this side of the world, we have traditional. And traditional is what I call pay at the exit. It is tax deferred. That means when you put money in, you get a deduction, and that tax is deferred on the contribution and on the earnings until you take it out, until you distribute it to yourself. Now, Roth is different. Roth is pay never. It is what we call tax preferred because there's no tax. You are putting after-tax money into it, and it grows tax-free, and you pull it out tax-free. Now, when you convert, and let's talk a little bit about terminology, okay? If I do a rollover, that means I am moving from a traditional plan to another traditional plan. That's a rollover. A conversion is when I roll from traditional over to Roth. Now, you cannot roll backwards. You cannot roll from Roth to traditional. It only goes traditional to Roth. So let's just say that I want to roll over $100,000. Oops, and there came my eraser. Let's not do an eraser. All right. So I'm going to roll over $100,000. I am going to have to pay tax on the 100K. All right. So when you do a conversion, you have to pay the taxes. And what we want is a way to mitigate those taxes, meaning knock them down. We don't want Aunt Iris, Uncle Sam's evil wife, Aunt Iris, I-R-I-S. We don't want to fill her up with her coffers. So what are we going to do? The first thing I want you to do is avoid the withholding trap. No withholdings. See, here's the deal. You convert $100,000 and you decide you want to pay the taxes on the $100,000. So you're going to withhold 20K. You withhold the 20K to pay taxes. That means that only $80,000 is actually going into Roth. Okay. Now, this withholding, this 20K, is considered a distribution. And if you're under 59 and a half, there is a 10% penalty on that distribution. In this case, the penalty by itself is $2,000. So you're having to pay $2,000 plus the tax. If you can pay it out of pocket, you will avoid this penalty. No withholdings. All right. The second strategy, and let me just move up my notes. Bear with me just a moment. The second strategy is called matching. Okay. When we match, what we are trying to do is create a paper loss in a business or a deductible rental. And I've got tons of videos about when you can deduct rentals and when you can't. All right. So we're going to create a loss on paper. Let's just say that that loss is 100K. That's our target. We match it to the $100,000 of income from the conversion. And 100K minus 100K equals 0. So the net effect that we have, if we can create this loss, is that we can convert from traditional to Roth and pay 0 taxes on the conversion. Well, how do you do that? Two of my favorite ways, depending on the company, are to purchase equipment or an automobile, or both. We have this wonderful thing called bonus depreciation. And bonus depreciation this year is 80%. So let's just say that I went out and I bought a forklift. Now, I'm not telling you to go buy something that you don't need. If your company needs a piece of equipment, like a forklift, or if you need a vehicle, then go do this. Let's just say that that forklift is $100,000. It's an 80% bonus depreciation year. We get an $80,000 write-off. So 100K minus 80 leaves us with a $20,000 piece of income that we have to pay taxes on. That's not too bad. We've reduced it. Now, you could do both equipment and an automobile, or more than one automobile, or more than one piece of equipment. So let's just say you buy a vehicle. You have to make sure it is at least 6,000 pounds. And guys, I've got videos on how to do this. But let's just say that you're buying a BMW SUV and it's costing you $100,000 times 0.8, there's $80,000. Now you could do both. You could wipe out that, and then you have another $60,000 that you could apply against your other income. Now, if you're a real estate professional, and Real Estate Pro has some very specific requirements, and you have rentals. So I'm just going to say RP, Real Estate Pro, you have rentals. Now you can do a cost segregation. Cost segregating means that you are accelerating the losses from depreciation. Residential rental property is depreciated over 27 and a half years. But what we can do is we can have a cost seg study that pulls the components of the property out of the house and depreciates them over a shortened lifespan. What am I talking about? Window frames, doors, countertops, cabinets, land improvements, this kind of thing. So we do the cost segregation, and it's also subject to bonus depreciation. Now, here's the deal. You don't have to have bought the property this year to do the cost seg. If you bought it between 2018 and 2022, this is 100% bonus depreciation. If you bought it in 23, it's 80%. If you wait till next year, it's 60%. It's in phase out right now, so it's dropping. If you bought it before 2018, it's probably going to be 50% bonus depreciation. But my point is you can create a deductible loss fairly easily, and this is totally a loss on paper. And because it's depreciation, the bank's just going to add it back when calculating your ability to borrow money. And we use this, we offset the income. We match things up. Now, Roger, I don't own a business. I don't have rental property. There's got to be something I can do. There is. Let me teach you a strategy called chunking. What chunking is, let's say that I am in the 24% tax bracket. I'm right in the middle. I can take a chunk of that 401k and convert it up to the point that I am just under the next tax bracket and still be in the 24%. Let me show you how this works. Now, first off, let me tell you, this works best, absolute best in the 22, 24, and 32% tax brackets. Now, you can do it at any of the lower brackets, okay? This is just giving you an idea. So, here's an example, okay? Here we go. Let's say that this year, you're going to make your family $200,000, okay? And you are in the 24% tax bracket. That bracket for a married couple, okay, it runs from, come back here. Where's my notes? It runs from, oh, there we go. My bad. It runs from $191,000 up to $364,000. So if I make 200K let's say that I convert the difference. I can subtract the 200K and I can take $164,000 out of my traditional 401k and convert it to Roth, and I will still be in the 24% bracket. Now, let's just say that I have $500,000 sitting in that traditional 401k. I convert 164 this year. This is year one. That leaves me $336,000. Okay. Now, let's go to year two. Let's say that I make $230,000. I am still in the 24% tax bracket. Okay. That tops out again at 364. I made 230. That means I can convert 134,000 and I'm still in the 24% tax bracket for that. So 134, that leaves 202. This was year two. And now I'll go to year three. What I'm doing is breaking this up into bite-sized chunks so I don't have to pay a whole lot of extra taxes. It doesn't flip me over to the next tax bracket. Now, this requires tax planning because if there's any surprises, let's say you did this in January and oh, surprise, you got this huge honking bonus that threw you into the 32% bracket. You wouldn't want to do that. So this is stuff that we always do at the end of the year because once we move it over, we can't move it back. All right, we're going to close out of the whiteboard and we'll finish up. There you have it, guys. There are ways to convert and mitigate the taxes. You can do the matching that I just taught you, especially if you're in real estate or you have a side hustle or another business, by creating a loss totally on paper. You can use chunking. And remember, when you do the conversion, don't have the taxes withheld. Hope you enjoyed today's segment. Until the next time, Roger out.